Hi, hello, welcome friends. In this video, I am going to discuss about types of bonds. So there are different types of bonds will be existed in the market. So there may be zero coupon bonds, deep discount bonds, convertible bonds, payment in kind bonds, fixed rate bonds, floating rate bonds, long term bonds, inflation index bonds, callable bonds, puttable bonds, junk bonds, masala bonds, etc. So this type of different types of bonds will be existed in the market. So now I will explain about types of bonds or debentures. So for example, I have explained in a last video about related to date convention, dirty price, clean price, etc. And we have introduced the concept like there is a capital which is required to start a business. For that business, there are two types of capital may introduced by the persons promoters. So one will be equity and another will be debentures. So in the debentures I am explaining different types of debentures or bonds, etc. Now here, if this kind of companies whatever will have less cash inflows, then the company has a less cash inflows. Since asset business is new, so when the business is new, you will be have less cash inflows in your business. So for that business, they have different types of bonds they may issue by the company. For that different types of bonds, I will explaining now. So for example, if you started a new company, you business how less cash flow inflows, it is normal because at the time of starting you need to inflow the cash, means into the business is main required, and we should not have that much of sales, that much of income at the starting level. So we need to maintain that. This is the case, you need to issue the types of debentures. So expansions like introducing more product from the company or starting operations in new location countries, etc. So most of these terms equity shares to public or equity funds, etc. However, if they confident about profit and more cash inflows, like in after 5 years, after 10 years, so at the starting they may doubt they will have profits or not. So at that time they want a fixed amount for the investors, so the company will issue the bonds. So bonds will be maybe first bond, there may be zero coupon bond, or it is also known as a deep discount bond. Zero discount bond or deep discount bond, in this case our issuer means here company will issue the bonds, will not pay any interest, and rather it will issue the bond at discount, and it will repay at maturity. Face value will be repaid, and that difference amount will be considered as coupon or interest. Example, for example, if you have government of India has issued 6 months bonds at 90 rupees, and it will repay at 100 rupees, that 10 rupees will be considered as interest or coupon, whatever you want you can take the name. And it also known as deep discount bond. So for example, if you want to write the entries, journal entries, what will be the entries? If you are invested in the bonds, the entry will be investment in bonds account debit to cash or bank, but that 10 rupees is different is there now for 10 years bonds. So every year you need to account 1 rupee, 1 rupee, 1 rupee. At the end it will become the bond 10 rupees, sorry 100 rupees, and you will revert that 100 rupees and getting that money at the end. So for that purpose of entry will be investment in bond debit account debit to interest income will be every year entry will be recorded for the purpose of interest accounting entries. And after that payment in kind, so payment in kind also known as a PIK bonds. So in this case company will issue, or company issuer will not pay any cash, so they will not pay any cash. So for that purpose, by not paying the cash, they will issue the bonds. So other bonds will be issued for interest portion also. So all of them will be paid at the maturity period. So at the maturity they will repay the amount. So for starting every, if for example if you have a bond, it is a 6 months of semi-annually bonds, if by interest is paying on semi-annually, but they don't pay any cash in as form of interest. So they will issue another bond for that interest portion. At the end, they will calculate the bonds, all bonds. By taking the all bonds into consideration, they will repay the amount. This is payment in kind bonds. Next, convertible bonds. Convertible bonds. In this case, the company need not pay all the amount on maturity. They can issue the shares to the extent of redemption value of the bonds. So whatever the amount redemption value is there now, for that redemption amount, they may issue another that bonds into shares. So then the person who is given borrowing amount, that person will become the owner. So for example, Flipkart borrowed some amount from market and it issues the bonds. So amount is repayable in after 5 years or 10 years, and they don't want to expect the company's profit make by then, and they can issue the convertible bonds or debentures with 5 years or 3 years, etc., etc. So at the end, they will ask, if you want to cash, we will reduce in cash. So they will repay the amount. If you want to become a owner, we will convert this bonds into shares. That are convertible option will be there at the convertible bonds. So mostly companies issue like Airtel, Reliance, Tata Capital, Muthoot Finance, etc., etc. These companies are recently issued these bonds. And after that, fixed floating rate bonds. So fixed rate bonds means here company issued 10 years bonds, and they will pay same interest for every year. That is fixed rate of bonds. Mostly we will see in the government bonds. So they will fix the fixed rate will be issued at the time of bond issuing time, and they will pay the interest on fixed. They will not change the interest rate accordingly. That is interest rate bonds, fixed interest, fixed rate bonds. And whereas some floating rate bonds will be there. Floating rate bonds means in this case issuer like companies pay the interest based on interest rates in the market. So it will base will be taken in the market. If the interests are increasing, they will also pay more interest to investors. If interest rates are low in the market, and they will pay low interest. So here what we will see, so here interest rates will be basing will be market. Based on the market, they are paying the interest. So when the person more interest is paying and interest rates are low in the market, and they will pay. So based on the market and interest rate will be in a direct relationship will be existed, and they may use the benchmark interest rates like repo rate or rebo labor rate, LIBO or labor rate, Sonia rate or SOFR rate or MIBOR rate, etc., etc. They may use for this type of bonds rates. So fixed market rates. And if the issue like Reliance issue may use it paid by saying that we will pay the interest based on repo plus 2%, repo plus 3%, etc., etc. They will pay the interest rate. If we example, repo rate will be 6%. Now 6% plus 3%, 6% plus 2% means 8% interest will be payable. If in second month, if the interest rate was become 8%, 8% plus 2%, they will pay the interest on that payment. So they will take the base will be based on market. There will be interest rate and market rate will be in a direct relationship will be existed. That is the floating rate bonds. And now inflation index bonds. Inflation index bonds means this is the bonds pay based on the interest rate. In floating rate bonds, we have taken the base will be market. In inflation index bonds, they will take the base will be inflation. So even though inflation increases, inflation decreases, they don't bother this type bonds. So investor need not worry the inflation being high or the interest income will be low. So if the inflation was increasing, interest become low. So for that it is not worry. So why? Because based on inflation, the company will pay the inflation. Mostly these senior citizens, depending on the interest income on for daily needs, they can go for this type of bonds to increase their inflation. So inflation, that increase in price of food, rent, daily necessity, work, rents, etc. So they will not create any trouble to them if go for inflation indexed bonds. Next, there may be some options: callable bond and puttable bonds. So that is callable bond means, and puttable means what? Callable, puttable. Here callable means that company or C that is company or issuer will have a right to call and repay the bonds debentures principal amount to the investors. And here they have a right, they don't have the obligation, so they will repay the principal to the investor at any time. If the company have money, they will repay. So for example, the bond, if company issued, so Reliance company issued callable bonds in 2022 with the tenure will be 10 years, and they say that repay will be 20,032. So 2022 issued, 2032 will be redeemed. However, if they have cash in 2023, they can ask the interest investor to take money and submit this bond. So for example, if you see in Corona, the Reliance company was become debt zero debt company, means that has repaid all its debts. Same like as the companies will take this option, but in this case, so the company will, we expect they may get cash anytime, or they think interest rate will go down in future, so they can borrow at lower interest. They issue this type of bonds. So here there is a reinvestment risk will be existed to the investor. So when there is a risk, return will be high. So investor will expect the interest rate of these bonds will be high. So reinvestment risk means what? Reinvestment risk means the risk an investor has to get the similar interest they were receiving earlier when company pay that money to them before the maturity. So before maturity, if the company is repaying, they will, investors will search for minimum same rate of bonds in the market. So if you person investor may find or may not be fund, so that reinvestment risk will be there, so that company will pay the high interest in callable bonds. And where has puttable bonds means investor will get the right here, and it is not obligation. So wherever the callable option will be no obligation, puttable also no obligation. So here puttable means investor will get the right to redeem this bond at any time. Here for example, fund invested in company Airtel debenture bonds in 2022, and which maturity may be 5 years, means they will repay 2027. So in 2024 or 25, investors need some money, and whenever he need money, he need to submit that bonds to company, and company will redeem the amount, and company will need to pay the amount at any time. So here issuer has risk, so here company will have a risk. So when company have risk, they will give the less return. So here investor will not have the risk, so whenever he want money, he will get. That is the case puttable bonds and callable bonds. There may be other types of bonds will be existed, that is junk bond, credit risk bonds, high yield bonds, non-convertible, masala bonds, etc, etc. And where these bonds junk bonds means normally it is a high yield bonds. So what can we see in high yield bonds means, for example, if you take, just a second here, I think mic was kept there, so that okay, whatever will happen, we want to discuss now. So I am discussing these bonds. Name will be whose securities will be masala bonds, securities bonds, amortization bonds, corporate bonds, municipal bonds, government bonds, etc. Gilt bonds. There are different types of bonds, and some that green bonds also existed there. So if you see the junk bonds, Junk bonds means these bonds will be issued by the company with low credit rating, and these are named based on who issued the securities. If government issued the bonds, they call sorry, it is guilty bonds means guilty bonds. Guilty bonds means this case will be there, and where has overseas when the government issue na that bonds will be guilty bonds, and overseas related bonds or offshore bonds means, for example, masala bonds means issued by Indian company or government in another country, other country in Indian rupee. So our government will go to the USA and issue the bonds in USA at Indian rupee. That bond will be masala bonds. Or for example, Kerala government related to corporations issued these masala bonds in UK, listed in London Stock Exchange in previous cases, and there may be separate bonds will be there. So different countries, Japan country also issued in US market samurai bonds. I think that bonds will be there, and after that green bond means these are the bonds issued by the company for the purpose of investing in environment friendly projects. So green bond means what? This bonds company issued by the company for the purpose environmental friendly projects like wind energy generation, solar energy generation, etc, etc. So this bond gives less rate of interest since investors are okay to invest, since there is social responsibility for investors to invest in these bonds. So social responsibility will be there for all investors, so they will give less interest in green bonds because company will not utilizing that amount morely for the purpose of company's purpose. So it is using for environmental friendly project like wind energy generation, solar energy generation, etc, etc. And a year, so the interest rate will be less. After that, convertible bonds or non-convertible bonds. So most of the companies issues non-convertible bonds. They are repaid by the company on maturity. So the company will not finding many investors to buy their bonds, they can issue convertible bonds. Already we discussed convertible bonds in above only. And YTM, what is meant by YTM? Yield to maturity. Yield to maturity, this is the internal rate or known as IRR, calculated on the bond based on future cash flows from that bonds. So assuming if Airtel and Reliance is issuing the bonds today with a 5 years tenure and coupon rate will be 10 years, so we can calculate the YTM assuming the interest payment frequency of Airtel, that is semi-annually, Reliance annually. So there will be different years, different time period will be there for Airtel and Reliance. So Airtel is issued semi-annually and Reliance is issued annually. So where same rate, where will get the more income in Airtel because they are issuing in paying in semi-annually, that after 6 months you may have option to reinvestment that interest amount, so you will get the more amount in this case. So this is YTM means yield to maturity. Guilt bond means what we discussed. Guilt bond means I think we missed that bond. The guilt bonds means what we discussed na. Firstly, that bond last bond we had discussed about. Sorry yaar, junk bonds I think so, yes. Junk bonds we missed na. So junk bond means where this bonds issued by company with low credit ratings. I think we are missing something here. Okay, when will be issued this junk bonds? When the company with low credit rating. So when the company has low credit rating, that means repayment capacity of that company is low. They may default on repayment of principal, particularly if the economy is in recession or industry in which that company is facing financial difficulty. So when company has a financial difficulty, they may issue, company may default, so they will give the high interest rate for this bond. For example, if Vodafone India is in after the merger, their performance is low, because they may issue this type of bonds, and they must offer high rate bonds. So this is called as junk bonds. So junk bond means what? Companies performance is low, company's credit rating is low. Because of that, company's credit rating is low, company may means not mandatory, may repayment of principal may default, so that it will provide the high interest rate to the investors, attract the investors. So company may issue the chunk of bonds. Next, guild bond means or corporate bonds or municipal bonds. These bonds are issued by securities. If government issued the bonds, they will call as guild bonds. If, for example, if the government corporation, that is municipal corporation, that is KMC or HMC, Hyderabad Municipal Corporation, or Bangalore Municipal Corporation, Mumbai Municipal Corporation, or Chennai Municipal Corporation, if the municipal corporation issued, the bonds will be municipal bonds. And overseas related bonds or offshore bonds means what we said that Masara bonds we use now. Masara bonds means Indian company or government is issued in other country in Indian rupee, that will be masala bonds. For example, Kerala government issued in USA government, Yankee, that is issued US company listed in US, non-US companies will issued, or Bulldog one bond is there, which is non-UK company in UK, listed in UK. And that samurai bonds is there, that Japan, I think Japan non-Japan companies listed in Japan stock exchange. These are different bonds will be there, offshore bonds or overseas bonds. And we are discussed about green bonds. The green bond means for the purpose of investing in environmental friendly projects, that is wind energy generation or solar energy generation, etc. So these bonds will be given by the company with low interest rate. Convertible bonds, we have discussed that convertible bonds and non-convertible bonds. And after that, that bond or DIIT, that bonds are elephant bonds. So what is this elephant bond means? Elephant bond means this is the bond issued by the government of India for the purpose of. So if you see, I think last 2 years or 3 years they introduced that one concept related to black money. So when government asking, you must give whatever you have black money, they will take only 50% and 50% will be given to you. That the scheme was introduced in, I think, last 3 years back. And after they will have provided 1 year time, I think so. And after the 1 year, if the government identify that money person has black money, they will levy the amount, interest, tax, penalty, up to it will goes to 80%, 85%, maybe it will go. So now the government will giving the option to the companies or persons, so they may invest in elephant bonds which is issued by the government, and the government will not repay any interest amount, and they will not disclose your name in anywhere, and they will give the some maturity 3 years or 5 years. Up to that maturity, you need to kept your money in elephant bonds. After the maturity, they will repay that principal amount, so that black money will become the white money. For example, if you have a 10 crores amount in your house that is in black money, that black money means if you are not paid that tax amount relating to 10 crores, that is become the black money. So if you invested that 10 crores in that elephant bonds, after 3 years or after 5 years, they will repay that 10 crores to you. It will become the white money. That is elephant bond meter, means elephant bonds. And we have discussed that YTM concept. YTM means IRR bond based on the future cash flows, that bond will be issued. So there may be different coupon rates, different time period. Based on that case, YTM will be decided. So in if you go for the concept, they will be there year, and they will be there the coupon or interest rates that may be known as cash flows, and by taking this YTM we will convert into present value, and that present values will become the amount to you. That is the concept of YTM.